Welcome to another episode of the Diary of an Apartment Investor podcast. This is your host, Brian Briscoe, and going to talk a lot today about the economy and how the economy affects real estate. I think a lot of people, if you're paying attention to what's going on, we've seen the federal funds rate go from basically zero to we're in the 2.5, 2.75 range right now, but the Fed is anticipating another interest rate hike of another 75 basis points in about 10 days from now. Today is September the 13th, 2022. And this episode is going to be released on September the 14th. It's helpful to understand how that affects properties. So number one, we've had a lot of inflation over the last 2 years. Okay, that inflation has generally come because the Fed has pumped a ton of money into the economy. A lot of when we talk about economics, a lot of it depends on supply and demand. If demand is higher than supply, prices go up. If supply is higher than demand, the prices will go down. Okay, so with all the money that got thrown into the economy, there was a much higher demand than there was supply. And this goes from goods and services, whether you're talking about buying an Xbox or a used car, a lot of those things were hard to get. And so the prices went up higher because there was more demand than there were current product. Same thing happened with investments. There were so many people that were extremely liquid. They're like, you know what, let's invest. Let's put money into the stock market. Let's put money in Bitcoin. Let's put money into real estate. So all of those investments during late 2020 and 2021 went absolute bonkers in a good way. They went up and up and up, and there seemed to be a lot of euphoria with it. But now we got to the point to where that's created a lot of inflation. The fact that there was not enough supply to meet the demand meant that prices had to go up. They couldn't go anywhere else. They had to go up, and that's inflation. And now we're at the point to where prices have gone up so much in the last year, roughly 10%. And certain things like food prices have gone up even higher than that rate. A lot of people now are making decisions between whether they're buying just the necessary stuff or whether they're going to buy something a little extra special, that discretionary spending. So what's going to happen, I think, is the Fed is going to continue to push those interest rates up. Interest rates going up tends to cool off the economy. People have the companies and people cannot borrow money as easily. And it makes a lot of things slow down for a lot of reasons. The Fed is probably going to continue to raise rates, another 75 basis points. It's going to make debt a lot harder to get, or a lot more expensive to get, maybe not harder to get, but more expensive to get, which is going to affect pricing across the board on pretty much everything that happens. People who could afford a car at a 3% interest rate 6 months ago now may not be able to afford that same car. People who could afford a house now can't afford that house for the same reason. When you look at what's happening with the interest rates are going up to curb inflation, and that's going to chill the economy. And what should happen, and what I'm betting is going to happen, is we are going to go into a recession that's a little more deeper than I think a lot of people anticipate, because a lot of people have been saying, oh, hey, 2 consecutive quarters of negative GDP growth, we're in a recession. But wait, there's other indicators for recession. A month ago, we were at 40-year lows on our unemployment rate. So we had not had an unemployment rate lower in 40 years. That does not feel like a recession to me. What I think is going to happen is that Fed's going to keep on pumping up the rates until that inflation comes down. And the only way that inflation can come down is if they curb the demand. How do you curb the demand? You cause a recession. All right. You make it so companies are laying people off. And it's the hard truth. It's probably not going to be the soft landing that the Fed said they would have, where everything's going to be hunky-dory. We'll just raise rates a little bit, bring them back down. Everybody's going to be happy. Inflation's going to be in check. But realistically, we're probably going to have a little bit more of a winter financially, just because of where the economic data that came out today said we're not quite as good as a lot of people hoped. The stock market took a nosedive today, and it's all based on the fact that the inflation numbers weren't as good as people wanted them to be, which means the Fed has to keep pushing rates up. Now, there is a bright side to this, and this is the key to everything. That the Fed has another mandate besides price stability. I mean, they're supposed to keep prices stable. That's one of the things that they are supposed to do. But their second mandate is to keep full employment, which means they don't want to see that unemployment rate go up. They don't want to see employment go down. And so what we're going to see is They're going to put in measures in place to fight inflation, but those measures are also going to bring up the unemployment. And once inflation's in check, they're going to, I don't see any other way. Once inflation's in check, they're going to have a higher unemployment rate. The only way to fight that is to bring rates back down. All right. Hopefully they do it slowly, like they should have done the rate increases, maybe starting a year ago, bringing them up slowly for that soft landing. But what I see is going to happen is we may have higher interest rates. So looking at our Freddies and Fannies right now are low fives, the treasury's above 3 now, low to mid fives is where we're seeing our agency loans. We may see fives, we may see sixes again before this is over, and then rates are going to come back down. What does that mean? It just means you have to be a little more careful buying. All right, you have to make sure that it's cash flowing. And I've said this many times before, you probably want to come in with a little larger down payment, or banks are probably going to force you to come in with a little larger of a down payment to give yourself an extra cushion. All right, but how long is it going to last? I don't know, maybe a year, but however long it takes to bring that inflation rate down to probably a 3% range. And once that inflation's at a 3% range, I think we're going to see more quantitative easing. I think we're going to see the Fed drop that funds rate. When that funds rate drops, the treasuries are very likely going to follow. And when the treasuries follow, most interest rates on the products that we see in this space are also going to go down. There are some loans that are based off of SOFR, the standard overnight funding rate. I think that's what it's called, secured overnight funding rate. Let's go with that one. And that's more directly tied to the federal funds rate. Anyway, what's probably going to happen is, we're going to see stock market go down. We're going to see it go down a lot more than it has in the last 8-9 months so far, just because the Fed's pushing us into a recession. So as apartment investors, what do we do with that? We educate. All right. We tell people what's going to happen. Here's the economics that are going on. Here's what happens when the Fed raises the funds rate. Here's what happens when unemployment goes up. Here's what happens when all of this happens. And then we can always point out that real estate has been a pretty decent hedge to inflation, and it's also been very resilient during recession. So we have all those things going for us. And right now, I think there's a couple things we can do. We can educate our investors. We can still buy. We just need to be a little more careful, making sure the numbers meet, not trying to actually push the numbers to make them work. But I still think it's a decent time to buy as long as you're careful. 1, 2, 3 years from now, when the Fed lowers that rate back down, interest rates come back down, I think you're going to see prices skyrocket again. Ideally, anything you buy in the next year or two is going to see a lot of appreciation coming back up in the next couple of years.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.